Shalom and welcome to our presentation. You're encouraged to either take notes, you can replay segments of the presentation, or you can also print out the notes pages view of the entire PowerPoint, which includes all of the dialogue. This presentation is designed to show you how to make your accumulated wealth go further. It's a presentation on estate planning, and we will focus primarily on how to reduce the tax burden to the money that you will leave for your heirs. We will also show how this strategy can enable you to provide more money for charity, such as Arthur Bailey Ministries. This is not some get-rich-quick scheme, some lofty dream, or even a scam. This is based on merely being a good steward with the resources that Yahuwah has entrusted us with. You don't need to have millions of dollars to make this plan work. Also, you can be single or married, young or retired. However, there is an assumption that you are either earning money or have already accumulated money. For the basics, we'll cover the 3 phases of financial planning and 2 wealth transfer strategies. Each financial planning phase provides a solid foundation and ensures success for the next phase. So, next let's look at financial planning phase number 1. The first financial planning phase. The foundation phase is where everyone starts. When you have a job, earn money, buy things, and establish a checking savings account. It's basically a foundation for your future. This phase has 3 attributes. Prepare. This is where we start saving for an emergency fund. It is typically in a savings account. Protect. As our assets grow and we start having others that depend on us, we look to obtain health, disability, and life insurance. Most employers provide these benefits. And document. This is possibly one of the most overlooked items and will become important in a later phase. This attribute includes putting together a will, specifying a power of attorney, and having a health care directive, also known as a living will. We will talk more about wills later. Now let's look at the second financial planning phase. The second financial planning phase. The accumulation phase is as it sounds. You have been successful in earnings and have been able to invest money and look forward to retiring. Many of us are currently in this phase or beginning to transfer to the third phase of financial planning. During this phase, the goal is to be the ideal steward to properly manage our cash flow. This phase has 4 attributes. Give to charities like House of Israel. O. Tax minimization and debt reduction. Minimizing one's tax burden is a key strategy we'll review later. Live. Achieve your life goals. And grow. Short-term goals, college savings, retirement savings. Next, we'll look at the third financial planning phase. The third financial planning phase. The distribution phase is the third and final phase of financial planning. This is perhaps the most important phase, and we'll learn how to make our money that we received in the accumulation phase stretch the farthest. This is the legacy planning and wealth transfer phase. We'll spend most of the remaining presentation discussing this phase. In this phase, there are 5 attributes. Impact, a positive influence for family and society. You can help to teach others around you. Ideals, these are stewardship driven. Interact, multi-general communication. Have a positive impact on your children and even your grandchildren. Show them how to be successful and start early. Intent, protect assets and minimize taxes. And inspire, maximize giving to family and charity, again, like House of Israel. Intent and inspire, along with stewardship ideals, are the most important. But before we delve into how to best utilize the distribution phase, let's first look at 2 wealth transfer strategies. Wealth transfer strategies. In the wealth transfer strategies, we want the maximum amount of our money to go to our designees or beneficiaries. In order to accomplish this, and be the best possible stewards, our goal would be to give to charities and heirs and not to the government in the form of taxes. As we'll soon see, most of us unfortunately will give a lot of our money to the government when we go to sleep awaiting for Messiah's return. It is just something we don't think about or plan for. Until now, that is. We all know about income tax, but may not have a good idea as to what estate or inheritance taxes are. Although the amounts and percentages vary from state to state, most have estate and inheritance taxes in addition to income tax. The assets that are exposed to this type of taxes primarily are real estate, bank accounts, personal property, etc. These assets account for nearly 1/2 of the average American's wealth. To help clarify, let's put our assets and money into 3 tax categories. First is red. These are exposed to estate, inheritance, and income tax, the highest tax bracket. Next is yellow. These are assets exposed to estate and inheritance tax. And third is green, almost no taxation when properly set up. So similarly to a traffic light, we want to get the green lights and avoid the red lights as much as possible. Now let's take a look at what most people have. Current wealth plan. As previously stated, this is what most Americans have in place. We have red assets that are comprised of our IRAs and 401ks. This makes up about 60% of the average estate, but it's also subject to the most tax. The accompanying tables and charts are based on total combined assets of $500,000. Please note that not everyone will have this amount, but the strategies still work since they are based on a percentage of total. In our current wealth plan, we have about 10% going to a charitable organization such as House of Israel. Remember how we previously stated the importance of a will? Here is where it comes into effect. If we want our money to work for the kingdom when we depart this world, it must be stated in the will. Otherwise, our assets can get tied up in probate, and Uncle Sam and all billers will get their portion first. Even if your son or daughter remembered that you wanted 10% given to charity, it's really too late. Although it still can be given, it would be after taxes and not before. The remainder of our assets will go to our heirs and family, and they would then be responsible for paying the high taxes. In most cases, the year in which your heirs receive this benefit, it will put them into a higher IRS tax bracket and subject them to higher taxes for all of their income that year. Here's how this looks. Of your $500,000 total in assets, you have $300,000 in your retirement accounts, such as IRAs and 401ks. Remember, these are red assets, and look at how much will go to taxes, 41.5%. Of course, this percent will vary from state to state. You have $200,000 in personal property and bank accounts. From your will, you had 10% go to a charity, which reduces the overall taxable amount to $180,000 in this example. And please note that charities, like House of Israel, don't get taxed on donations, and neither do you or your heirs. In this example, it actually works to lower the taxable amount. And these are yellow assets and are taxed at a much lesser rate of 4.5%. And again, that amount varies by state. And you have some green assets, such as the 10% that was given to charity. Now, for the not so good. Over 25% of all your hard-earned money and assets will be confiscated by Uncle Sam in the form of taxes. Although you avoided taxation on the 10% charitable donation, everything else was heavily taxed, thereby reducing the amount for your heirs. Next, we'll look at our first strategy to reduce taxes. The first wealth transfer strategy. This is the first of 2 methods that illustrate how to reduce the amount of taxes that will be taken from your money. Remember that the red assets, our traditional retirement accounts,
are the ones that are taxed at the highest rate. Our goal would be to reduce what's in these red assets and therefore reduce overall taxation amount. This strategy would leave only the yellow assets for the heirs, which results in an overall lower taxation. Also remember that charitable giving isn't taxed. Our first look was giving 10% to a charity based on what we had in our will. A better method would be to change the beneficiary in your IRA and/or 401k, those red assets, to a charity, such as House of Israel. But please note, a beneficiary designation on an IRA or 401k will always take precedence over anything that's specified in the will. By following this strategy, you would greatly reduce your taxable assets, give money to your heirs at a reduced tax rate, and be a great steward at the same time. Here's what this strategy looks like. In this strategy, we can readily see that at the 41.5% tax bracket for the red assets, we wouldn't be paying any taxes. For the yellow assets, which will be left for our heirs, it's taxed at a lower rate of 4.5%. So out of the $500,000 that we started with, we would now only be paying $9,000 instead of the normal $132,000. Hey, that's a savings of nearly $125,000. The pie chart and table shows the breakdown. So instead of paying 26% total in taxes as before, we now only pay 2%. Of course, therefore, an additional 24% of our money goes to work to help take the gospel to the ends of the earth. Another difference between this strategy and the do nothing or current plan is that your heirs would receive, though, about $150,000 less, while the charity receives over $280,000 more. Hey, at least this should get you thinking about estate planning and associated tax strategies. So let's take a look at one more strategy. The second wealth transfer strategy. In this strategy, we'll still be giving $300,000 to charity, but now we'll be providing an additional $350,000 to our heirs, both tax-free. Just as before, we would change the current beneficiary of your IRA and or 401k, those red assets, to a charity, such as House of Israel, and we avoid the 41.5% taxes. Also, as before, we'll leave the yellow assets to our heirs at a 4.5% tax rate. The biggest difference is we'll now purchase wealth replacement life insurance policy. This is also known as Survivor Universal Life. Life insurance is the only asset vehicle that doesn't have any taxes. The policy will pay out to the designated beneficiaries and supersedes what the will specifies, and this policy doesn't need to be mentioned in the will. As previously mentioned, your heirs, the policy beneficiaries, would receive the insurance benefits tax-free. Now we would need to analyze how to purchase such a policy. These survivor policies assume a life expectancy of 90 years. The most opportune time to purchase would be from 55 to 65 years old. You can be younger or older. Just remember that a younger person would pay a smaller premium, but over a longer period of time, while an older person would pay a higher premium over a shorter period of time. And also, the healthier you are, the lower the premiums will be. Any recurring income or cash flow greater than your daily needs can be used to pay for the insurance premium. One suggested method would be to use the amount you are required to withdraw from your IRAs at age 70, the required minimum distributions. And as with most life insurance policies, you must be insurable, that is, in reasonably good health. Just as in the first strategy, we have no highly taxable assets in our estate, nothing in the red assets. The $300,000 has been designated to, let's say, House of Israel via beneficiary change, which is non-taxable. The $200,000 in our yellow assets is left to our heirs at the lower taxable rate of 4.5%. The difference, now via the Survivor Universal Life Policy, an additional $350,000 goes to our heirs and designees. This entire amount is tax-free, or green. It can also be set up as a trust for minors, such as grandchildren. The pie chart shows that although the same dollar amount goes to charity, it's a smaller overall percentage of total. The heirs get the yellow assets that has the smaller tax percent, which is about $190,000 after taxes, and get the $350,000 life insurance policy for a total of $540,000. This strategy would represent the best of both aspects, heirs and charity, and enables the money to go further and do more. It ideally minimizes what goes to the government in the form of taxes. We would all look forward to hearing Yeshua tell us, "Well done, good and faithful servant," in Matthew 25, verse 21 and 23.
Financial planning steps. You may be asking, well, what do I need to do next? Well, if you're currently in the foundation phase, ensure that you're taking advantage of your employer's financial benefits, specifically medical, dental, vision, and 401k enrollment. Most companies offer a free matching 401k contribution, so try and contribute at least the minimum amount to maximize the employer contribution, which is free. Remember that 401k pre-tax contributions reduce your overall federal tax burden every payday. Try to save 10% of your paycheck and put into a savings account. If you have sufficient emergency funds in this account, consider investing any amount over a set goal, for example, $10,000, into a certificate of deposit or a CD. These are FDI insured, available through your bank, and offer a much higher rate of return, an interest rate, than a savings account does. In parallel with this, don't neglect tithes and offerings, as Jehovah will bless you financially and in other areas. Also, think about getting a will. If you're in the accumulation phase, make sure to speak with a financial planner, and more on this on the next slide. Financial planners will show you a portfolio of your assets, when you can retire, and when would be best to commence getting Social Security payments. Remember that they should work for you. There is typically no charge up front. They get paid by a percentage of your asset growth when you invest. Is your will up to date? Most financial advisors can assist with legacy planning needs as well. If you're in the distribution phase, or at least 60 years old, speak with your significant other about your assets and how you both would like them allocated after you're deceased. Put an action plan together with your financial advisor that includes a wealth replacement life insurance policy or our Survivor Universal Life. Remember that we want to maximize our assets, minimize taxes, and make our money work for the kingdom via the charitable donation methods outlined in this presentation. Financial advisors. The who is in choosing a financial advisor, you have many, many choices. There are multiple companies that would love to get your money to invest. Although they all will promise to make you money, not all will have your best interests or your stewardship desires in mind. This is why you need to do a bit of researching. Your friends and family members may have recommendations of who to choose or who they use, but you'll need to discern carefully. The what? Well, ideally, you'd want a Hebrew roots or Messianic affiliated financial advisor. If you can find one, great, because some may claim to have a Christian background, but just because they attend church every Sunday doesn't mean that their company's investment philosophy aligns with yours. The where? Remember that taxation laws are different for each state. If you do find that perfect advisor,
Ask them if they are licensed for the state in which you reside or are intending to move to. As an example, one such financial planning company is Ambassador Advisors. They are biblically responsible investment strategists and fully understand the importance of charitable donations, wills, and tax minimization strategies. They also provided the information that was used to develop this presentation. For additional information, brochures are available at House of Israel through the Contact Us link on the web, or you can call Ambassador Advisors directly and speak with Matt Knoll.
Congratulations! You now have the information to make your money go further for you, for your heirs, and for spreading the gospel. Again, if this was too much information or is confusing, you can go through the presentation once more. Also consider printing out the notes pages. Contact House of Israel for the brochures. Also contact a financial advisor, such as one listed on the previous slide. Pray to Yahovah and seek his guidance on your financial assets and estate planning strategies. And this concludes our presentation. Thank you for your time, and shalom.